All right, so we have exactly or almost exactly 2 weeks left in the year, depending on when you watch this video. And I wanted to make a video of my top 20 stocks going into the year or to finish this year. And how I came up with this list was basically over the last couple years or so. And the reason I use that timeline is that's the timeline that I've been very serious about investing. Have been at a reasonable valuation, at least at some point in that time. Some of these have not for over a year, some of them, a very brief time. That's the criteria I came up with. I'm going to make another video of top 10 or 20 stocks that are just way too expensive that I really wish I could buy. I'll probably do that a couple weeks from now. So I'll separate those because I think I don't think it's necessarily a fair comparison to have one of stocks that are actually not crazy overpriced and some that are crazy overpriced. First things first, also, if you get value out of this video, please like and subscribe, comment. I really appreciate all that. I appreciate the support. So getting right into it, again, this is no particular order either. This is kind of just the way I wrote it down and narrowed things down. EQB, obviously this is a Canadian bank I talked about a lot. They are an online bank. They're growing extremely well. They're very profitable. This is pretty much a perfect, at least as far as banks go. This is probably the best one that I've seen. There probably is better ones, but this is the best one I've seen. I mean, you look at their earnings yield is almost 12%. They're only paying a 2% dividend, so they still have a ton of room to grow that dividend, a ton of room to grow, and they still are growing. Like if you compare EQB to like the big Canadian banks, like EQB is better in literally every way except they don't have physical branches. But I mean, as the boomers die off, they're only going to get more popular because the younger generation, they don't necessarily care as much about physical branches, especially considering most people aren't paid with checks and nowadays with DocuSign and all that kind of stuff, you don't really need to sign physical documents and whatnot anymore. So I think they still have a lot of room to grow, and I'm still very bullish on them. And they actually have pulled back a little bit recently, and I think that they are, again, if you don't have a position, I probably would be a buyer where they're at right now. I mean, they have less than a 9 PE. I think that's anything less than a 10 PE, I think for them is it's on sale. The next one is Go Easy, and honestly, that's an ETF, sorry. But as far as Go Easy goes, the main reason I added Go Easy is I think they're a good company, but I also think they're at a discount right now. I mean, they're in a pretty healthy correction right now. They are considerably below their historical valuations. So I think this, of all the companies on this list, this one is arguably the most cheap right now. Nothing's a guarantee. Obviously, do your own research. I could be wrong, but this one appears to be, at least from what I can tell, bird's eye view, this is probably the one that's the best deal. And I really like this company as well. They're in an industry that's going to keep growing. They have an earnings yield of 10.5%. They're only paying out just below 3% in as far as the dividend goes. So I think they still have a lot of room to run as well. They're not even a $3 billion company. So next on the list is Fixed Comfort Systems. This one's probably a tad expensive where it's at right now. If we look at its valuation here, yeah, they're actually quite a bit above their historical valuation. So definitely expensive where it's at right now. But I think that this is a really good company. This is another just phenomenal company. This is one that I would be head over heels to buy if the price was right. This one's probably in the top 10 if I had to narrow it down even further. The next one is ODFL. This is another one that this is a trucking company, but another one that I would be head over heels to buy if it was the right price. It is above its historical valuation, but you also have to keep in mind that is still a very expensive price. The average 5-year PE is like 32. It's currently at 34. I definitely would be 30, even 30. I think is probably generous. I would say maybe mid to high 20s if I was being honest. So it definitely has to come down a little more before I would get extremely interested here. But this is another one that I absolutely positively would pull the trigger if it got cheap enough. Absolutely, I would be head over heels. And virtually all of these I would be head over heels to buy if the price was right. Kinsale Capital. This is an insurance company, one of my favorite industries. They're actually quite a bit below their historical averages, but I mean the PE is almost 29, so they still are debatably expensive. I would argue they're probably about fair value where they're at right now. This company is growing extremely fast, and given that, it obviously deserves a higher premium. So this is another one. Really like this company. There's probably 4 or 5 insurance companies that I absolutely love. 3 of them I'm currently buying right now. This is one of them. So another one I just really like. MedPace Holdings. This is all of these. I believe I've made specific videos on all of these before, so I'm not going to go too into detail. This one I really like. They're in the life sciences industry. They're growing extremely well, and I think that they are below their historical valuations by a decent amount. But I mean, a PE of 29, that's still debatably expensive. It is growing quite fast, which is good, but this one, another one that I would say probably about fair value. I am actually slowly buying this one right now, but I am keeping an eye on that valuation, because if it goes any higher, I probably would hold off. The next one here is Lam Research, and this is another industry. Semiconductors I really like. Semiconductors can be highly cyclical, though. You got to be really careful not to be too. Even though the semiconductor industry has performed extremely well over the last 5 to 10 years, they can go through periods where they're down quite significantly. So you got to be careful about that. But if you're a long-term holder, I think that there's probably 10, 15, maybe 20 semiconductor companies that are really, really good, and I think there's probably less that I'm wanting to buy. This is one of them. The other one that I don't have on the list, but I think is close, is ASML. They did not quite make my last list, but I think that they're in the top 3 to 5, at least for me. The next one is WRB, and this is the other insurance company that made my list. Honestly, I wanted to add more, but I couldn't justify having more than 2. I mean, that's debatably too many. But WRB, they trade at a much more modest valuation. I mean, a PE of 14.6, and that's considerably below their historical average. So I really like them, and I mean they're growing faster than the S&P. So the S&P is currently at a PE of around 21. They're at just under 15, and I think they're going to beat the S&P. So this is one that I think this one's clearly on sale. I mean, fair value for this company is probably like, honestly, $75 a share in my opinion. MPWR, actually, I misspoke. This is technically another semiconductor related stock. This is one that is larger. They're not massive, just under 30 billion. This one is below their historical valuations, but they are still expensive. I mean, a PE of 68, a price to free cash flow of 47. The reason I justified putting them on the list is that they've grown there's good growth, and then there's phenomenal growth, and then this company definitely is in that list. So they are below their valuations by quite a bit. That's how I justified having them on the list, but they're still way too expensive. And I mean, if they've pulled back quite significantly over the last, looks like the recent history, but they're still up almost 1,800% in the last 10 years compared to the S&P, just under 300. And if you go to the last, let's say, 5 years, they're still up more than double the S&P. So even after its recent pullback. So this company has absolutely destroyed the S&P. Another one that, again, I would be head over heels to buy. The really good semiconductor names, those are ones that you want to have on a watch list, and you want to watch them very closely, because it seems like every 2, 3, 4 years, maybe 5 years, these companies will be at a very good price, and for the rest of that time they're way too expensive, or at least the majority of that time they're way too expensive. So a lot of these are ones you want to have on a watch list, and you want to just be patient and wait. And when they become a good price, or when they get to that good price, then you buy. Another semiconductor name, Applied Materials. This is one that's came down quite a bit over the recent past. We've seen some weakness in the semiconductor industry. I mean, Lam Research has done very well, but most of these names are actually down. I mean, NVIDIA I don't think really is, but most of these names are down recently. And like I said, the semiconductor industry it's a cyclical industry. It does outperform over the long run, but it is a very cyclical industry. The reason that I like Applied Materials is that this is another name that's historically beat the market quite easily, but they currently have a PE of below 20. So again, like I mentioned, a lot of people would say, oh, the S&P being at a PE of 21 is expensive. And that's true. I mean, historically, the S&P is like, what, 17, 18? But this is also a name that's also easily beat the S&P. So I think that it probably commands a low to mid 20s PE. So this is one that definitely is undervalued. Probably in that 180 to 200 is a share is probably fair value for it. So it's definitely undervalued in my opinion. But again, like I mentioned, semiconductor industry cyclical. It could go down even further. Applied Industrial Technologies, AIT. This is another one that I really like. All of these, like I said, I really like. A little bit of diversification here. This one's in a little bit of a different industry. It is below its historical PE, but it's above its historical price to free cash flow. But I think it's a little too expensive. This is a name that I expect to beat the market, but not by much. And considering it's that expensive, I'm waiting for a pullback here. Even though, if we look at the last, let's say year to date, it's still very close to its all-time high. So definitely waiting for more of a pullback here, but I don't think it's that far off, at least when it comes to this one. The next one is one I've talked about recently, Waste Management. This one hasn't been trading for a good deal for probably a year, probably since February. Honestly, would be the last time. So it's been almost a year since it's been at a reasonable valuation. But this is one that, like I mentioned in the video on Waste Management, is an absolute must buy if the price is right, because it's not as cyclical as the market. It's less volatile, and this is a name that's historically has beat the market. So definitely, this is one that I don't care what kind of investor you are. If the price is right, this one is just a must buy, because it's safer than most stocks. Not that it's completely safe, but it's safer than most stocks, and it's beat the market. So to me, it's just a no-brainer if the price is right. The next one is MSCI. This is one that I think was at a reasonable valuation back. It was below 500 at one point this year. I was buying then, but I didn't buy that much. I wish I would have bought more, because it is now over 600 a share, and it is too expensive where it's at right now. Really good company, but it's just too expensive where it's at right now. It is below its historical valuations, but a PE of 40, that's just too expensive for a name like this. The next one is actually MicroStrategy. This one's different, right? This is simply a play on Bitcoin, and the reason for that is I'm bullish on Bitcoin. I think it's going to continue to go up over time. I think it's going to continue to beat the market over time, and MicroStrategy has more exposure to by far more exposure to Bitcoin than any other publicly traded company has, and most likely more than any other publicly traded company ever will have. And given that fact, I think this company is going to continue to outperform the market. So it is definitely the most speculative, but I'm fairly confident Bitcoin is going to keep going up. So that's why I added it on the list. The next one is automatic data processing. This one you actually have to type in manually for some reason. This is one that has also not been cheap in a while. It's honestly more of a value play in my mind, but it's currently at a PE above 30. So I'm waiting for a pullback before I pull the trigger. But this is one that I really do like. And I mean, if you look at like a lot of these like hedge funds and like billionaires, this is like Waste Management is probably one of the most common, but this one's also really common. And the reason for that is that they're so good at preserving capital and growing capital over time that they're just no-brainers if the price is right. ITT is another one. Really like this company. It's in a good industry. It's in an industry that's growing. It's performed well over time, and I think it's going to continue to perform well over time. So I really like it, and that's one that I definitely will. I think it's not far off being a good deal if we look at its valuation here. Yeah, it's definitely not far off, but it is too expensive where it's at right now. The next one is GGG. This is Graco, and this one also too expensive where it's at right now, but it's not too far off. Actually, I think it is a little too expensive on second thought. Historically, it's right around its historical average, but this is one that I probably wouldn't be paying more than like a mid-20s multiple on. So it definitely would have to come down probably 20% or so before I would buy. But even within, maybe in the summer even, I think it was, back in like the summer and even up to like mid-September, early September, I think it was at a reasonable valuation. But it actually peaked out, it looks like back in March. So that's kind of interesting. But another one that I definitely also would be buying on a watch list, watching closely. Owens Corning. This is I've made a video about this one, I think kind of recently as well. This is also an industrial name. I think industrial is the most common sector. I don't know why. I think that there's just a lot of companies in that industry. Very good company here. And another thing you'll notice too is that most of the names that I've cited are like mid caps or smaller on the large cap spectrum. I don't know. The biggest company probably around 100 billion that I have on this list. So I think that is the sweet spot when it comes to size of a company to buy, because that 5 to I think 100 billion mark is the sweet spot, because they're companies that are established, but they also still have a lot of room to grow. And that's almost, I think virtually every company on this list is in that category. So that's another thing that I would mention here. Watts Water Technologies, this is the second last one on the list. This is another one that at points in time was at a reasonable valuation here. It looks like you could get it below 180. I was buying back then. I distinctly remember buying back then. I think it has to be below probably 190, maybe 200. Let's just check its valuations here. It is below its historical valuations right now. I would say below 200 I would be buying, so it's not far off. But this is another one. I really like this company. Definitely a buyer if the price was right. And the last one here is Carlisle, another one that I've talked about somewhat recently. It is expensive where it's at right now. It's below its historical PE. Honestly, based on PE, it's debatably, honestly, I am buying this company right now. I would say it's about fair value, because if you look at it based on free cash flow, it's almost exactly at its historical valuation, but based on earnings, it's quite a bit below. So on second thought, I would say it's about fair value where it's at right now, and I am actually slowly dollar cost averaging this one right now as well. So that is the list. Like I mentioned at the start there, if you get value, please like, subscribe, comment. I really appreciate all that, all the support, and stay tuned for more.